Imagine checking your account at the end of every month and seeing fresh cash deposited, passively, predictably, and without lifting a finger. Not from a job, not from side gigs, but from a strategy tied to the stock picks of one of the greatest investors in history. What if you could capture the essence of Warren Buffett's brilliance and turn it into monthly income? Today, we're exploring a groundbreaking way investors are attempting to do just that. But here's the twist. We're not talking about simply buying Berkshire Hathaway stock. That doesn't pay dividends and offers no monthly income. What we're covering today takes a different route. It's a vehicle that reimagines Buffett's approach, repackaging it for income-focused investors, and it's something even seasoned income ETF fans haven't fully grasped yet. Stick with me because in a few minutes you'll discover how this new fund compares against powerhouses like JEPI, JEPQ, and even BRKB itself. We're diving into yield, risk, diversification, and hidden drawbacks no one talks about. And by the end, you'll know whether this bold ETF deserves a spot in your portfolio, or if you're better off sticking to more proven income plays. Before we jump in, don't forget to subscribe to MoneyQuest Broker, your go-to place for uncovering smart strategic money moves. We break down the complex and make investing simpler for real people. Hit that subscribe button so you never miss a wealth-building opportunity. Let's begin by stating the obvious. Warren Buffett has built an empire. For decades, investors have tried to mirror his performance by buying shares of Berkshire Hathaway, but that's always come with one glaring limitation. It doesn't pay dividends. That's Buffett's style. He prefers to reinvest profits rather than distribute them. It's great for long-term compounding, but not ideal if you're seeking income right now. So, what if you could benefit from Buffett's investing strategy and still get paid each month? That's the premise behind a new kind of ETF that's starting to turn heads in the income investing world. It's not just another dividend ETF. It's a specialized strategy that takes Buffett's favorite holdings and turns them into a monthly income machine. Now, covered call ETFs like JEPI and JEPQ have already gained massive popularity by blending quality stocks with options to produce yield. But this new fund takes that idea and applies it directly to Buffett-style investing. It gives you exposure to top-tier blue-chip companies, but also includes an engine designed to generate consistent monthly cash flow. Let's set the stage by breaking down how this kind of ETF works, without naming it just yet. It's built on three foundational ideas. First, the goal is to deliver high monthly income, targeting around a 15% annual yield, paid monthly. That's significantly more than most dividend ETFs offer. Imagine turning a $50,000 investment into over $600 a month in passive income. Second, it provides exposure to the same type of stocks Buffett favors. Profitable, stable, large-cap businesses with strong fundamentals. Think companies with wide moats, consistent earnings, and staying power. Third, it utilizes a covered call strategy. That means the ETF sells call options on its holdings to generate extra income. This options premium is what powers the monthly payouts. Best part? You don't have to manage any options trades yourself. Professional managers do all the heavy lifting. Now, the ETF we've been building toward, designed to merge Warren Buffett's investment wisdom with high-yield income, is the VistaShares Berkshire Select Income ETF, trading under the ticker symbol OMA. It's still flying under the radar for most investors, but its approach is bold. Take roughly 20 of the same high-quality companies found in Buffett's Berkshire Hathaway portfolio, and layer on a professional covered call strategy to generate monthly income, targeting up to 15% annual yield. Let's talk about who this ETF is for. If you're nearing retirement or already retired, consistent monthly income becomes more important than long-term growth. OMA may offer a compelling stream of cash flow that can supplement Social Security or pensions. For example, a $100,000 investment could potentially deliver over $1,200 per month, well beyond what most dividend stocks provide. If you're a growth investor who's already overweight in tech or speculative assets, OMA can act as a stabilizing force. It diversifies your income sources while still keeping you tied to quality blue-chip companies. And if you're a Buffett enthusiast who's always wished his portfolio paid dividends, this ETF might feel like the answer to your prayers. It blends your admiration for Buffett with your desire for monthly income. But, and this is key, OMA is not a magic bullet. Let's break down the trade-offs, because when you target high income, something has to give. In this case, that trade-off is upside potential. Covered call strategies are known for capping gains. Here's a real-world scenario. If Apple, a top Berkshire holding, rallies 20% on strong earnings. The covered calls written by Omaha might cap your gains at just 5%. The rest of that upside goes to the buyer of the call option. So while you're collecting income monthly, you're giving up some of the potential long-term appreciation. That means in strong bull markets, Omaha will likely underperform both Berkshire Hathaway stock and broader market indexes. Then there's the issue of taxation. Many investors overlook this, but the income you receive from Omaha is typically taxed as ordinary income, not qualified dividends. That's a big deal. Let's say you're in the 24% tax bracket. Your 15% yield starts looking more like 11.4% after taxes. In contrast, qualified dividends may be taxed at just 15% or even 0% depending on your income. This makes Omaha more suitable for tax-advantaged accounts like IRAs or 401ks, where you can defer or eliminate those tax burdens altogether. There's also the expense ratio. Omaha charges 0.95%, which is considerably higher than the 0.35% fee you'd pay for JPI or JPQ, and much higher than an S&P 500 index fund, which might cost just 0.03%. That might not sound like much, but fees compound over time and quietly erode your total return. So how does Omaha stack up against the competition? Let's compare Omaha to the big three JPI, JPQ, and Berkshire Hathaway, BRKB. In terms of yield, Omaha is the clear winner, targeting 15% annually compared to GPI's 7 to 9% and JPQ's 8 to 11%. BRKB doesn't pay a dividend at all. Diversification, GPI and JPQ win here. They hold hundreds of stocks and offer broader sector exposure. Omaha holds about 20 names, making it more concentrated. It's more diversified than buying individual stocks, but less so than the other two ETFs. Stability of income? JPI and JPQ have longer track records of consistent monthly payouts. Omaha is still new, and we haven't seen how it performs across different market cycles. Fees? BRKB wins by default, no management fee. JPI and JPQ are also more cost-effective. Omaha's higher expense ratio needs to be justified by performance and income reliability. Growth potential? Berkshire Hathaway takes this category easily. Without a covered call strategy, BRKB has unlimited upside. Omaha's gains are capped, which makes it less ideal in strong bull markets. Tax efficiency? Again, BRKB wins. It generates no taxable income until you sell. The income from Omaha is taxed annually at your ordinary income rate. So what's the bottom line? Omaha is a fascinating new player in the income ETF space. It's essentially trying to create a monthly income version of Warren Buffett's investing approach. That's innovative, and for certain investors, especially retirees and income seekers, it might be a valuable tool. But this ETF isn't for everyone. It's new, it's expensive, it has limited diversification, and the tax drag could be significant in a taxable account. If you're intrigued, here's a smart way to approach it. Start small. Don't throw your entire portfolio at it. Consider a 3 to 5% allocation in a tax-deferred account. Watch how it performs. See if it hits its 15% target yield consistently. Monitor how it holds up in both calm and volatile markets. Compare its performance to JPI, JPQ, and even BRKB over a few months. That data will tell you more than any prospectus or marketing video ever could. Warren Buffett has said countless times that most investors should just buy index funds. But for those who want a little more income while still following his stock selection logic, Omaha offers a fresh twist. Just remember, there's no such thing as a perfect investment. Every fund comes with trade-offs. Your job is to find the right balance between growth, income, risk, taxes, and fees. Would getting a 15% yield, paid monthly, make a meaningful difference in your financial future? Let us know in the comments. And don't forget to like this video and subscribe to Money Quest Broker for more deep dives like this, where strategy meets simplicity and passive income becomes reality. This video is for educational purposes only. Always do your own research and consult a qualified financial advisor before making any investment decisions. Thanks for watching.